I always get excited when I make videos. All right, so here we are. Options and dealer delta hedging, part two. So in part one of our video, we went over what derivatives are, option functionality. We went over the difference between a dealer and a market maker. We went over the bid-ask spread and how it's formulated with dealers and market makers. We went over delta and its purpose and how it works on both the call and put side. And today we are basically going to go into dealer delta hedging. We are going to dive more into the difference between dealers and market makers and how delta hedging actually works when you're looking at an option chain. I'm going to show you guys an example of how your delta is going to move based off the call or put side. And if you are a positive or negative delta, depending on if you are buying or writing a contract, exactly how dealers are going to hedge those trades on the opposite side based off whether that stock is moving to the up or down side in real time. All right, so Winnie the Pooh. Quick recap. What is the difference between a dealer and a market maker? A dealer is the institution that is structuring the option products themselves. They manufacture the contracts, they list them, they price them, and then they take the other side. They're the one warehousing all the risk, okay? The market makers are a layer ahead of them. They quote the bid-ask prices, they keep spreads tight, and they ultimately pump their own liquidity into a brokerage platform, usually via payment for order flow, which is something you guys are well aware of with Citadel Securities and Robinhood. The spread that market makers are seeing on their side is tighter than the spread that they are offering you on a brokerage platform like Robinhood. Every single time that you click, you are immediately making them brokerage or bro. They're taking a specific amount of pips or cents on those trades in order to churn a profit every single 0 DTE, every single 1 DTE, every single weekly, monthly, quarterly options expiration. They make money no matter what. It is their business model to have you click the bid or ask spread as many times as humanly possible every single day. Okay, so what is dealer delta hedging? Let's start by first defining delta, which is the change in your option price based off a $1 change in the underlying security. Let's say your delta is 0.50 and Tesla stock goes from 440 to 441 and your delta moves by 5 cents. Then your option price is going to be worth 5 cents more if it's moving in the direction in which you positioned. And in layman's terms, if your option price is increasing by 5 cents, it goes from 50 cents to now 55 cents, you are making money against the person that is on the other side of the trade, which is the market maker and the dealer. But remember, the dealer is the one warehousing all the risk and actually taking the opposite sides. The market maker just does that deal with you and then passes on the risk to the dealer. For example, using Citadel Securities as a market maker, they may do a deal with you on Robinhood and then pass that risk to a GSIB bank, which is a dealer like JP Morgan. So the opposite side of the trade is where things get really hairy. And this is when talking about staying delta neutral at 0 is where dealers need to delta hedge their trades by continuously buying or selling the underlying asset to offset the delta they've created by holding that sell to open options position in the first place. When you buy to open a contract, whether it is a call or a put, someone is selling to open. They're writing that contract to you. That is the dealer side. Every single time, either yourself or a dealer sells to open, you are writing a contract. You are now basically taking the risk in full on that contract in which you have to dealer delta hedge and make sure your delta remains at 0 so you are not exposed on your side of the trade. If someone buys a call from you, you are writing that call, you are selling to open, that is negative delta. You have to offset that negative delta by buying shares of the underlying security, whatever it is, call it Tesla. If someone buys a put against you and you are writing that put, selling to open, that is positive delta. You have to short the underlying security in order to remain delta neutral at all times. And depending on which direction the market moves after you open that sell to open contract is dependent on how you're going to hedge more by buying more or shorting more or doing the exact opposite. And there are incredibly advanced algorithms that do this for hedge funds, high frequency trading, companies, asset managers, and a light speed basis. So they make sure that out of all the things that they have to hedge for, delta, gamma, theta, vega, etc., delta is taken out of the picture. Okay, so I drew you guys a quick diagram so you can visually see and understand how buying a call or buying a put and dealer delta hedging a call or dealer delta hedging a put would actually work without it being too confusing. These things can be misconstrued in so many ways. It is really super simple if you think about it the right way, and I'm going to explain it that way. So any one of you of any level of expertise and understanding can make sense of it. If you buy a call You want your call value to go from wherever you bought it from, and this is your delta, from that number up to 1. This is positive delta. You want your positive delta to increase. The more your positive delta increases, the more money you make on your call. If you buy a put, that is negative delta. The more your negative delta increases down to -1, the more your put value on your option increases. And anybody that's buying calls or puts on a day-to-day basis knows this game because that is what you do. You trade directionally. You buy calls or you buy puts. You buy calls if you think a stock is going or a security is going to move upward, thus having your delta move upward, positive delta, you make more money on your option. You buy a put, you expect the market to move downward. You want Tesla to go from 440 to 420, and you make more money on that downward price action because your delta is increasing negatively from wherever you bought it, let's say -0.4 all the way down to -0.9, and you make money in between that move. Now, on the opposite side, selling to open, writing you your bought call or bought put, they are writing calls or writing puts to you. They want the exact opposite to happen. They want your calls and delta to go to 0 delta. They want this, no matter where you bought your call, wherever your delta is, let's say it's 0.4, they want your 0.4 to go to 0. And if you bought a put, they want your put to become more positive, not more negative. So let's say you bought a put and the delta was 0.8. They want it to go to 0. On the dealer side, you want that person's delta to go to 0. So their contract expires worthless and you keep the full premium that you collected up front when you opened your sell to open trade. It is that simple, and don't overcomplicate it any more than that. When you look at an options chain, and yes, it can be very confusing because there's 1,001 numbers, you can see here in your delta column for calls, the higher you go up on the strikes, the more in the money the stock security is. This is intrinsic value. That is why your delta is rising. The more the stock goes up, the more your strike becomes in the money, the more intrinsic value it gets, the higher your delta moves. That's why you see delta go from 0.3 to 0.4 to 0.5, etc. in this direction upward on the call side of the chain. Contrarily, on the opposite side, you see the put delta going downward. And the more downward it goes, the more negative it becomes. Because when you're buying puts, you basically want the stock to move south. You want it to decline. So whichever strike that you bought, if the stock is moving downward and you're making money, that strike is becoming more and more in the money, in the money, in the money. And it's getting closer to that -1.0 where your put option is worth the most it could possibly be worth. Dealers are on the opposite side of this. They always want both the call and put side to end at 0 on their delta, so they expire worthless and the dealers keep all your premium. Okay, the last part about this that you need to know is that when dealers are on the opposite side of a trade and they're hedging the movement of that delta based off which direction the stock or underlying security is moving against them, they have to either buy or short more shares of that underlying security. For example, if an institution or you and myself as a retail trader buys a call, that's positive delta. We want that stock to move upward, so our delta increases. That's more positive delta. We make more money on the trade. The dealers on the opposite side, they don't take sides on the trade. That is the whole point of what remaining delta neutral actually means. They're not trying to go long or go short. They're basically just trying to make you a market and cover any exposure and risk and hedge the opposite side of the trade that they just dealt to you. So what they do in the instance of us buying a call is they're writing that call. That's selling to open. That's negative delta. So to hedge that negative delta, they have to buy shares of the underlying security. So if you buy a call on Tesla, they're buying shares on Tesla to hedge your call because they're writing the call to you on the opposite side. Now, contrarily, if an institution or you or myself is buying a put, that's negative delta. The dealer is on the opposite side of that trade, which is positive delta. So they have to hedge by shorting the underlying security, Tesla, in order to remain delta neutral. And depending on how aggressively Tesla moves up or down, they will either short more shares of Tesla or they will buy back their shares of Tesla. Same thing on the call side. They'll either buy more to hedge or they will sell their existing hedge to make sure that they stay delta neutral at all times. You are now experts at understanding the absolute basics on how dealer delta hedging works on the options chain. That concludes part 2 of our little documentary here about options and delta hedging. Part 3 will be the last piece. We're going to talk about open interest in full. We will discuss the main 3 overcrowded trades in the market right now that we're able to use options and dealer delta hedging to push the market higher from the October 2022 lows and 2023 lows all the way into the January 2025 and current all-time highs in November 2025 of 685 in the S&P 500.